Many countries will have a hard time avoiding a recession.
I think that bringing inflation down should be our number one priority.
The last few years have been challenging in terms of just the volatility that we've seen.
But this is the sharpest slowdown in 80 years.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Wednesday, the 8th of June. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The half-point hike club. Well, the RBI becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB tomorrow. More trouble at Credit Suisse. The company sees a loss at the group-wide level and investment bank in the second quarter. The lender weighs a new round of job cuts. And amid questions over his long-term leadership, UK Prime Minister Boris Johnson presses ahead with revisions to the Brexit deal as Rishi Sunak promises to cut taxes in the fall. Now, first thing is first, we do have a lot of top stories, and in the last couple of minutes, actually seconds, we have a Bloomberg scoop saying that Credit Suisse is probably looking at weighing a new round of job cuts after the loss warning that we had earlier. So we'll have, of course, a look at what Credit Suisse stock price is doing. For the moment, you can see European stocks down some 0.4%. They turned lower. U.S. equity futures also lower on persisting worries about high inflation and slowing growth. That, despite a lot of the opening actually being supported by technology stocks in China. You can see Credit Suisse, of course, warning on their profit, down some 7.3%. And then that Bloomberg scoop just seconds ago saying that they're also weighing a new round of job cuts after this loss warning. Now, let's get straight to what the European map looks like. This is one, of course, of a story of inflation. Tomorrow is ECB day, something that will be closely watched. I know, for example, in some of the periphery countries, they're extremely worried that spreads will widen if the ECB does not do something to contain that. So I would suggest getting into tomorrow, and we see that widening of the spread, for example, between Italian BTPs and German bonds. But that is probably one of the main market stories that we should watch out for tomorrow as well. U.S. Treasury Secretary Janet Yellen, meanwhile, told lawmakers that inflation is likely to stay high.
Let me say, I think that bringing inflation down should be our number one priority. And President Biden, in an op-ed on inflation in recent remarks, has indicated that it is our top priority.
And World Bank President David Malpass is warning of years of pain ahead. Speaking to Bloomberg, he raised the possibility of a global recession, though he said we're not there yet.
Many countries will have a hard time avoiding a recession. We're not in, it's not a global recession yet. It could, the downside risk is that it could be a global recession. One of the key variables is whether supply comes back online in order to add growth and slow down the inflation rate. But this is the sharpest slowdown in 80 years.
Now we're joined to talk markets and, of course, investments by Rupert Harrison. He's portfolio manager for multi-asset strategies at BlackRock. So many questions, Rupert. First of all, on where do you hide if inflation's coming or a policy mistake could bite us?
Well, look, this is the challenge for markets at the moment. I think we're not past the peak of this inflation problem. And central banks, so we've got the ECB tomorrow, overwhelmingly focused on inflation and not at all sensitive to what I think is going to be a coming slowdown in growth. I think that might be the story by the time we reach the end of the year. But for now, inflation absolutely the driver of policy. And I think we are, at the moment, maybe in a little bit of a pause in this sell-off in risk assets. Yeah. Positioning is now extremely low. There's maybe some short-term relief from China as the kind of reopening after some of the COVID lockdowns. But I still think this is not a great environment for risk assets, not a great environment for corporate bonds. We like owning alternatives, gold, other diversifiers in portfolios.
So gold is what, a hedge against inflation? Is crypto a hedge against inflation?
I mean, I don't really see crypto as a hedge against anything. I think it's a speculative asset, really, as a mainstream asset class. I think that gold is a good hedge against fears of inflation. Okay. Ex-post turns out not to be a particularly good hedge against inflation.
Is there a danger that actually we have too many hikes and then they have to cut in 2024, a lot of central banks? And I don't know how you play that in the markets.
Yeah, so look, I think that the policy error narrative is something that I think will emerge particularly in Europe later this year. I think that the slowdown in European growth and in the UK is going to bring, whether we get an actual recession or not, I'm not sure, but I think we will end up with growth very, very low, close to zero. And I think that central banks at the moment are overwhelmingly focused on that inflation challenge, but that growth concern will take over, particularly as the kind of peak inflation data start to recede later in the year. In the US, the fundamentals are just that much stronger. We've already seen
recession.
Well, I think we are seeing a slowdown. I think we're going to see manufacturing PMIs in the ISM, for example, down towards 50 or even below by the end of the year. But we've got a huge amount of balance sheet strength for consumers. We're seeing already actually credit data start to pick up in the US to kind of take up some of the slack. So I think the US has that much more momentum.
Do you worry about the ECB not doing a kind of backstop for the widening of spreads between, for example, Italy and Germany, or is that a market play?
Yeah, look, I think that is a concern. We've obviously heard this sort of suggestions that they have some plan coming to try and narrow the spreads. It's not clear what that, but we've been around this so many times with the constraints of the capital key and things like that. Yeah. I think in an environment where the central bank is overwhelmingly focused on inflation and where growth is slowing, that's going to remain a concern.
So, but you wouldn't buy any European periphery bonds or anything like that. What would you buy in Europe?
So we continue to like energy equities. I still think that for now that the tightness in those markets, agricultural sector, I think that these are kind of medium-term stories that are going to continue to play out. We continue to be underweight European equities overall. Still think that the growth slowdown is something that is going to drive risk assets generally lower.
So we have a mini survey. I mean, I call it mini, but actually it's quite a mega survey because we ask everyone who comes on which commodity will do best and which will be the worst through year-end.
Best, probably still oil.
Yeah.
Worst, I'm not sure, to be honest. It's.
I mean, dynamics are quite. Again, we're kind of assuming, of course, that the war in Ukraine stays on for a long time. I don't know what's being priced in, or whether markets are moving a little bit away from the immediate impact on war and longer-term inflation prospects.
Yeah, so I think in commodity markets, and particularly energy markets, it's not just about the war in Ukraine. Look, it's going to be very hard to forecast the month-by-month developments there, although I would certainly personally fade any sort of short-term hopes of ceasefires or resolution there. But energy markets are tight for a lot of other reasons. And I think that that's going to remain the case for the foreseeable future.
Rupert, how do you play China? Do you play China?
So yeah, absolutely, we do play China. I think that we've been underweight, neutral to underweight Chinese equities for some time now. Yeah. We've seen quite a sharp bounce in some parts of the market in response to this reopening. Every now and again, we get these sort of stories and signals that, for example, the sort of regulatory crackdown is easing, policy easing is coming. I think our bias at the moment continues to be to kind of fade that positive news. I don't see a fundamental change in Chinese policy coming. I don't think that they are going to resort to large-scale stimulus. I don't think that there's the ability or will to do that. And I still continue to think that those Chinese assets at the moment require some kind of premium to sort of make them attractive.
Okay, Rupert, thank you so much. Rupert Harrison there from BlackRock stays with us. In the meantime, we also need to look at Credit Suisse. We understand from our Bloomberg reporting that it's weighing a fresh round of job cuts, part of a renewed push to slash costs after it warned this morning of a second quarter loss. Now, the job cuts are, according to people familiar with this matter, so it hasn't been confirmed, but certainly on the back of that warning of a second quarter loss, the share price of Credit Suisse down 7.3%. Now, coming up, we talk banks. We also talk about the UK economy with BlackRock's Rupert Harrison, who says it's not all doom and gloom. That's next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Britain's economy remains in the spotlight as the cost of living soars, the pound sinks, and the tax burden hits the highest level since the 1950s. The UK's Chancellor, Rishi Sunak, has promised to cut taxes at his next budget in autumn to lessen the burden. Now, in the latest piece in the Evening Standard, BlackRock's Rupert Harrison says to ignore the doomsayers, as the UK is and will remain a powerhouse of global services exports. Well, Rupert Harrison is still with us. Rupert, I mean, the idea, and it's true when you speak to money managers like Hoff, say, look, I'm just not comfortable at the moment with the UK because everything we're dealing with, productivity, a labor shortage, inflation is kind of coming to the forefront in the UK and being exacerbated also because of domestic issues. Are you brave enough to invest in the UK right now?
Well, I would have to differentiate between the short term and the medium term. I think you can make an optimistic medium term case. There's a huge number of sectors where the UK is still world leading and has huge opportunities. I think in the short term, I have to agree that I think the energy shock, the growth slowdown, and some of the sort of political risk makes it a very challenging environment. Where I do think there is maybe some opportunities is I think that the Bank of England is very aggressively priced to continue hiking. I think that the kind of growth slowdown will probably overtake that by the end of the year. So probably less negative on gilts than some other bond markets.
Okay, I mean, is it the test case of what, on how difficult it is for central banks to balance this juggle?
Yeah, I mean, in many ways, the Bank of England has unusually been at the forefront of this whole story, right? So like, when we saw those big moves in the front ends of bond markets, a lot of that was led by the Bank of England with kind of very abrupt turnaround to sort of sharp hiking signals. I think that with their latest forecast, we also saw, I think, a sign of things to come, particularly maybe for the ECB later in the year, where they're forced to acknowledge very sharp slowdown in growth towards zero into next year, really highlighting that very stark trade-off that central banks are facing. And it may be that the Bank of England is the first to be forced into some kind of pivot as the growth slowdown starts to bite.
I always say this because I know you're former chief of staff of George Osborne, so you understand not only politics in the country better than most, but also the Conservative Party. Like, what kind of policies and the impact on the economy will we have by the end of the year?
So I think that at the moment the politics is less of a market issue because I think the fiscal stance of the government has now largely been set. We had that big intervention from Rishi Sunak to deal with the cost of living. It was pretty big. We're talking 1.5% of GDP. I think with him still in number 11 and the Treasury as a sort of someone who cares about the public finances, I would be surprised to see another big loosening in fiscal policy. I think that path has now largely been set. That will help to cushion the slowdown. It will certainly help for those on lower incomes because a lot of that money was focused on them. But I wouldn't expect a kind of big change in the overall policy stance.
Where do you see sterling? Because, it's been, one of the most interesting, maybe, currencies out there.
Yeah, still looking to play sterling largely to the downside. I think, as I say, I think the Bank of England is priced relatively aggressively relative to the path we'll see over the next 6 months. I think that concerns around growth and the energy shock will continue to drive lower rather than higher.
Are we underestimating, and this is not only for the UK, but in general, some of the supply chain shocks that companies need to deal with? So we talk a lot about, the companies that have the pricing power and that can bring prices up to deal with inflation, the ones that don't. But some of them also, have struggled to get some of the parts.
Yes, look, what we have all been, I think, or many people have been wrong-footed over the last year to 18 months is the persistence of these problems. And I think we know now that that's going to continue to play out. The sort of on-off of COVID lockdowns in China is the latest thing to kind of prolong that story. I think that supply, and particularly labour supply, actually, is going to be the kind of big defining trend over the next 18 months or so. Like, if we do see labour supply coming back really across the developed world, then that's going to make life a lot easier for central banks. I think that'll be a better story for risk assets. In the UK, interestingly, if you go back 6 to 12 months, it was labour shortages that were the big story. And interestingly, that has resolved itself for most sectors in the UK. So I think that's less of a problem. We actually, interestingly, now have very high levels of immigration again in the UK. And I think that that's, again, coming through in a way to sort of solve some of those labour supply shortages. So that may be a sort of optimistic little silver lining for the UK economy, that those labour supply shortages are really much less acute than they were.
Rupert, thank you so much. As always, Rupert Harrison, they're a portfolio manager for multi-asset strategies at BlackRock, joining us this morning. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Angela Merkel has warned that isolating Russia is not possible in the long term. In her first public appearance in front of a larger audience since leaving office, the former German chancellor said Putin had made a big mistake by invading Ukraine, saying there's no excuse for this brutal aggression. Sources say Merkel repeatedly spoke to Putin in the early days of the war, calling for a ceasefire. Now, Bloomberg has learned that the Biden administration is seeking to wean the U.S. off of Russian uranium imports. Sources say the White House is pushing lawmakers to support the $4.3 billion plan to boost purchases of the nuclear reactor fuel from domestic producers. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, hedge funds were tallying gains on their hottest bets in years when Dan Sondheim reached an unusual deal with JP Morgan to go even further. With the bank's help in August 2020, Sondheim's D1 Capital Partners used its stakes in private companies as collateral for borrowing $2 billion that the firm could put towards yet more of those stakes, amongst other things. Now, last year, that focus on private companies looked brilliant as D1 updated its valuations and posted a whopping 70% gain in that part of its portfolio. Now, the industry is bracing for a reckoning. Across Wall Street, billionaire investors and their advisors are urgently trying to figure out how much exposure they have to plunging values in Silicon Valley unicorns and other private ventures. Well, joining us now to discuss all of this is our very own Danny Berger. Danny, you're an expert in hedge funds, so they've basically been dipping their toes into VCs.
Yeah.
But because tech is tanking, it's a bit of a nightmare.
Yeah, it really is. And this is something that, as you were talking about, there are often leverage bets for these hedge funds. So yes, interest rates rise, the valuations of these go down. And hedge funds are kind of in this unfortunate position where a lot of private funds, they are only really assessing these investments. They only have to look at selling them maybe 3 to 7 years. But hedge funds, they'll report quarterly or monthly results. So their clients are looking at that and saying, hey, these are falling. We want to get out. We want to sell these. But they're really hard to sell. I mean, they're a liquid asset.
Liquid, exactly.
Yeah.
But they were meant to be immune also from volatility.
Right. And of course, that's not true when you have to assess them every month or every quarter. Because again, that immune from volatility assumes that you're not marking these to the market every single day. And look, the hedge fund industry has gotten a lot, the private equity industry has gotten a lot of criticism about this as of late as the market has turned. Cliff Asness, for example, he's a hedge fund manager, so maybe a little biased because he just does public equities, called it volatility laundering, basically saying that it's this appearance of illiquidity, or it is illiquidity, but that's making it appear less volatile. But actually, it's just as volatile as everything else. You just don't sell it as often.
All right, Danny, I have so many more questions. I know we'll get you back on to discuss this further. Danny Berger, there, our Daybreak Europe anchor, and you can read our full Big Take. It's a great one. I'll also push it out on social media on NI Big Take Go on the Bloomberg terminal. Coming up, Credit Suisse's string of troubles continues. While the Swiss bank expects a loss for the second quarter, we'll dig into that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Credit Suisse says it expects to make a loss at the group-wide level and at its investment bank in the second quarter. Now, it blamed challenging market conditions after Russia's invasion of Ukraine and tightening monetary conditions. Just in the last 20 minutes, also, Bloomberg has learned that the lender may be planning further job cuts. The stock is dropping this morning. I think it's around 7.2% lower, now 6.5% lower. Now, let's bring in Tom Metcalf, who leads our finance coverage here in London. Tom, I mean, they just can't catch a break, right? We also spoke to the chief executive in Davos. He was in a quite cheery mood, or certainly more relaxed, but every time it's a loss or it's something that's not quite working out.
Yeah, here I am again, talking about Credit Suisse again. And I mean, this is particularly extraordinary because I think this week one of their top bankers was coming out saying, hey, we've moved all this, beyond this, we're okay. And then today, statement, another quarterly loss. And then that news just now that, they're obviously looking at more job cuts pretty much across the bank. So
why? I mean, I don't know whether there's an underlying, is it that they just can't get ahead of it, or is it they keep on making mistakes?
Yeah, it's one of those situations. The things they pointed to was Ukraine, the rise in rate environment, but all banks are dealing with this. So it does seem that perhaps they're just kind of continually stumbling over their feet. They just can't draw a line under these number of scandals. So perhaps it's just the cumulative effect of that. And I really think investors, you see with the share price, is really starting to lose patience now. Yeah,
currently down 6.5%. Is there anything else that jumped out at you in the statement?
Well, before about 20 minutes ago, I was going, that's an interesting line about costs. So we know what that kind of probably suggests now. It does sound like they're really, this June 28th meeting when they're doing a deep dive with their investors, that's going to be pretty significant. It sounds like they're really going to lay out how to sort of steady the ship. So it'll be interesting to watch that.
Where does this leave the chief executive?
Well, it's the perpetual conversation around him, right? Like, they've come out and said, look, my mandate's clear. The chairman came out recently and said I'll fall back in. But it's 2 years into his tenure, and it's pretty much just been marked by scandal and the inability to move forward and set a clear path. So his sort of future is definitely in the spotlight.
I mean, there were always rumors about possible mergers or selling off assets. Is any of that going to come back?
I mean, yeah, there's a perpetual sort of rumour in the market, I suppose. I mean, I was looking at the market cap earlier today, and it's something like 16 billion Swiss francs. So, I mean, Credit Suisse right now is extremely sort of cheap in historical terms. But obviously, then you look at statements like today, and you wonder, you know, who would want to buy it?
Tom, I mean, interest rates going higher doesn't really help them, right? Because this is a whole other set of problems.
Yeah, it's an interesting dynamic there, right? Normally, higher interest rates will at least help, you know, most parts of lending, etc. I think what was interesting, as they did flag this in the statement, is Asia in particular, clients seem to be staying on the sidelines, and that is going to really hit their fee income, particularly in wealth, the big growth area that they're targeting. So I think that's probably the worry, is maybe it's the volatility and the uncertainty, and right now it's just they can't catch a break.
Tom, thank you so much. Tom Metcalf there, who leads our finance coverage in London. Now, coming up, a new era of monetary policy for the euro area, maybe ahead as the ECB pivots to confront the threat of inflation. We preview tomorrow's rate decision next. This is Bloomberg. Well, the half-point hike club, the RBI, is something that we need to watch out for. It becomes the latest central bank to raise rates more than forecast, with Poland's decision later today and the ECB tomorrow. More trouble at Credit Suisse. The company sees a loss at the group-wide level and investment bank in the second quarter. The lender weighs a new round of job cuts. And amid questions over his long-term leadership, the UK Prime Minister Boris Johnson presses ahead with revisions to the Brexit deal as Rishi Sunak promises to cut taxes in the fall. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it is Wednesday, the 8th of June. Armed with new forecasts and with prices rising at a record pace, ECB President Christine Lagarde and her colleagues look set to end trillions of euros of asset purchases and cement a path of exiting 8 years of negative interest rates at tomorrow's monetary policy meeting. Well, we're now joined by Hedge Mehta, Senior European Economist at Legal & General Investment Management. Hedge, thank you so much for joining us. So many questions on the ECB, because we heard from Christine Lagarde. She tried to get that governing council to be on the same page. A lot of people saying like she tried to do a Draghi, but then we still had calls for hikes. So what are you expecting from the ECB?
So I think obviously in terms of tomorrow's meeting, it's going to be very much talking about the need to act, ending the asset purchases, taking policy away from that kind of extraordinary stimulative level. But I think, the hawks have got the upper hand at the moment, given where inflation is. It's still likely to creep a little bit higher. She's going to face some pressure where she's taken the unprecedented step of laying out effectively the path for the next 2-3 meetings. She's facing quite a challenge.
And Hedge, if you look at money markets, so they're expecting a 50 basis point hike by July. I mean, that's pretty punchy.
Yep, I agree, and it completely flies in the face of the gradualism message that they've been trying to tell us for a long time. But the last few months have been, extraordinary in terms of what we've seen, and I think that there's a very high chance that is where they end up going.
We made some great charts. Actually, thank you, Valerie, as always, for putting some great charts together with us. Now, we're looking at the balance sheet for the ECB, but maybe we can also look at the components to Eurozone inflation, which is one of the most interesting ones, because a lot of it is also, flights, airplanes. Do you expect inflation to have reached its peak, or can it get much worse from here?
It's most likely close to its peak now, but there are still some risks to the upside. Big unknowns in terms of food prices, energy prices. There are lots of shocks that are still there. I mean, the supply constraints have not all abated either, and exactly how that plays out. Economists' inflation models have been broken for a long time, so I think we have low conviction in that.
I also have two other great charts. Now, one is basically the bond spread, for example, between Italian and Spanish bonds, and this is one of the biggest concern. I mean, I caught up with actually Italian MPs yesterday, and so they said the ECB has to support them at some level, because otherwise it could be really, really ugly for them. Will the ECB do it?
I'm a bit sceptical they will do anything concrete other than some sort of verbal intervention in the short term. I mean, there was the speculation recently that they are all willing to sign off on some sort of program. It's just going to be really hard to get another Draghi-esque, whatever it takes moment. And remember, there are lots of people who want the bond purchases to come to an end. Exactly fine-tuning the minutiae of it so it can favour one country over another, I think is still going to be difficult.
So if we don't get some kind of agreement, and there were rumors in certain press, you know, what happens to actually Italian BTPs? So they blow up, and then do we have another crisis on our hands?
I mean, it's a risk, and I think this is why the ECB has to be more gradual than other central banks. They can't afford to shock markets. So where other central banks can be more aggressive in terms of hawkish surprises, trying to bash down inflation expectations, the ECB has to tread more carefully. And maybe that's why we've seen that more telegraphed short-term path. But in the absence of them trying to at least give some, not illusion, but at least some idea that they could step in if really required.
But that won't be enough, right? And I guess, is it a philosophical concern of hiking rates and buying bonds, which is a great Valerie question?
Well, I mean, it's ultimately the market could test the ECB's resolve, and we've seen that before. But we're still a long way away from see where we were 10 years ago with the sovereign debt crisis. Remember, the ECB has a huge chunk of BTPs on its balance sheet. So the Italian Treasury gets a nice kind of kicker from that, where Italian debt financing costs are not as high as the actual yield we all see on our screens.
Yeah. But again, if that, you know, if they don't, I guess, take care of that for the moment, and this is because of Russian gas, right, and the dependence of Italy to Russian gas, then could we see some kind of, I mean, I wouldn't go as far as maybe an IMF program, but could we see a Eurozone crisis back on our hands?
I think we could definitely see spreads widen further from here if there isn't some more support. But I do think that actually the Italian structural budget has actually seen some improvement. Obviously, we've got a bit of fiscal easing going on at the moment, but you can have some reasonable assumptions and still have debt relatively stable.
All right, Hedge, thank you so much. Hedge Mehta there, Senior European Economist at Legal and General Investment Management, joining us this morning. Now, coming up, Deliveroo, Oatly, and Goop. We speak next to the venture capital founder Frédéric Cour about how to spot these trends in retail and tech. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the conversation on venture capital. Frédéric Cour has been in the industry since 2001, and he's built a record of spotting trends early in technology and retail. Now, he racked up big wins as the first investor in Farfetch and early bets on mobile payments platform Zong and Dailymotion, earning his European awards for investor in the year of 2012 and 2019. Then in 2015, Frédéric launched Felix Capital, which focuses on early stage investments in digital lifestyle opportunities, new brands and platforms. Its portfolio includes Deliveroo, Peloton, Oatly, and Gwyneth Paltrow's Goop. Well, we're delighted to be joined by Frédéric Cour. He's Felix Capital founder, and he joins me now. Today, it's also announcing an injection of new funds. It will be doubling in size to $1.2 billion. Frédéric, thank you. I feel like this is a great moment to catch up because you're also doubling in size. You've gotten so many things right. Is there an investment that you regret making, first of all? Is there something that was a mistake? And then we'll get on to your successes.
They are, I think, at the right time, we always make the decision with the data we have.
Right.
And then the key for us is to not overexpose ourselves with too much capital in the wrong opportunity. So, it's difficult to point to a specific, you're putting me on the spot there. But overall, we are very pleased with the community of founders that we built, which has overall helped us to get to where we are today.
How difficult is it, and first of all, congratulations, of course,
Thank
on
you.
doubling your fund. How difficult is it to understand the trends going forward? So I know we were taken by surprise by inflation. If you look at Netflix, we all thought that we were going to watch more TV, but this was more of a pandemic era thing. So is it more difficult to spot the trends in 2-3 years because of COVID?
I think that today all our industry, where we are very focused on micro, because we're backing businesses that are typically quite small, and then we back them for the long term. We're sort of humbled by macro because inflation, interest rates, all of this impacts our industry a lot, especially when we make investment decisions at a certain point that will typically get a reading 5-10 years later. So these things are quite different. Consumer behaviors are where we're focused. Economic environment, that's where we have to navigate. The key is not to make the wrong decision, especially on price, which has been harder.
But it's harder. But I mean, okay, Oatly. I've been drinking Oatly for a long time, and then the valuation came in. I was like, why didn't I think of that? So you spot these trends. A lot of people spot them in their daily lives, but without making money investments. How do you do that?
We spend a lot of time watching people, watching how people live, watching how people, especially younger generations, who are setting trends, and that's and looking at social media, for instance, it's an amazing resource.
Through algorithms.
Well, through data, but also through just watching, through looking at hashtags, looking at what's getting momentum, and younger people in particular, because they're very much setting the direction. Gen Z and millennials, who are now getting older as well, impacting every single generation.
We're still millennials. I'm certainly a millennial at heart.
Me too.
So how, what's the next big trend? What do you want to invest in now?
I mean, to some extent, things haven't really changed. The economic environment has changed a lot, but when we look at the micro level, the companies we've backed, for the most part, are still doing really well. Maybe the cost of goods have increased, maybe some of the marketing expenses have increased, but the trends towards people wanting to have a better life thanks to technology, so wellness broadly defined, that's a fundamental trend. The trend towards a more sustainable lifestyle, that's a very long-term trend as well.
In terms of retail or in terms of
in terms of really every aspect of our life, from electric mobility to shared ownership, to plant-based eating. This is a very profound trend.
So one of the things that actually surprised me, for example, was payments, the Klarnas of this world, of you pay over a certain amount of time. I mean, I remember speaking to chief executives of big banks saying, this is the next big thing, I want to get in on that. And actually there were doubts of this in the last couple of days.
Well, this trend is very, very strong. Maybe what we've seen in the past couple of years is some exuberance on some of those aspects. So I think, personally, I underestimated the power of buy now, pay later. It's been embraced by consumers in a very compelling way. The question is, what are those companies offering that service worth? Because the unit economics on this service are pretty thin. And so maybe there needs to be a readjustment there.
I mean, do a lot of the companies you're invested in, do they have price elasticity? Because they tend to be on the higher end. Is it easier to pass on consumer costs to them?
So not all on the higher end. I mean, if you look at electric mobility with shared scooters, that's pretty affordable. We backed a company in Germany called YFood, which is offering a kind of meal in a bottle, which costs around 2 to 3 euros. So that's very affordable. There is some price elasticity up to a point. So a lot of what the companies are doing today is looking at their cost base, looking at their margin structure, looking at their offering as well to focus on the best offering.
When it comes to food, do you worry about food accessibility? We also had this pretty incredible story about KFC having to replace the lettuce with cabbage because there was a shortage and it was too expensive.
Well, we haven't seen that at the level where we operate, but obviously that's more of a bigger trend for people to worry about. I think what we are seeing is a rise of interest in experience, in hospitality. The restaurants are full, so people are going back to the real life, and food is very central to this.
The other question is basically if you look at how easy, I don't know if it has been easy actually to raise capital, but what kind of investor do you have invested in you? Is it people that used to be in public markets that rather have it in private?
What we've seen that in our industry in venture capital, we've been lucky to have from the very beginning people who've been thinking long term. We understand that it's important to be invested across cycles. So our fundraising happened pretty fast. More capital than we expected from existing investors, typically blue chip institutions, fund of funds, endowments, foundations, and some pension funds, and some new investors as well from the US, but also increasingly from Europe, which is a great sign for Europe.
Brilliant. Frédéric, thank you so much, as always, for coming on. Frédéric Courder, the founder of Felix Capital. Now let's get straight to a Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse says it expects a loss at a group-wide level and at the investment bank in the second quarter. The troubled lender warns market conditions remain challenging after the invasion of Ukraine and monetary tightening across the world. It says that led to weak customer flows and ongoing client deleveraging. Now, tech stocks have jumped in China as the government's latest batch of new game approvals bolstered bets that the industry's outlook is indeed on the up. Bilibili and Alibaba led the rally after China's entertainment regulator approved licenses for 60 new games as what is seen as a step towards policy normalization. Now, Francine, what is the most expensive city in the world to live in as an expat? For the second year in a row, it's Hong Kong. That's according to the ECA International. Higher prices and a strong currency kept the city at the top. New York, Geneva and Tokyo round out the top 5. And that's your Bloomberg Business Flash. Francine, actually, London in the top, it's 4th place now. So quite high there.
I'm not surprised. I feel like my cappuccino has increased by like 30% in the last 6 months. I'm not surprised at all, Leanne.
Well, it's not cappuccinos increasing, Francine. Apparently, it's rent. So we're just all paying a lot more rent.
I know. I've seen certain parts of London 25% higher, and then you wonder why people don't want to come back to work in the city. Leanne, as always, thank you so much for the update. Now, the UK's Chancellor of the Exchequer, Rishi Sunak, has promised to cut taxes at his next budget in the autumn. It was one of the demands of some members of Boris Johnson's Conservative Party who almost deposed the Prime Minister this week. Now, Bloomberg's also learned that Johnson plans to press ahead with legislation to override parts of the Brexit deal. Well, joining us now is Lizzie Burden, our EMEA EcoGov correspondent. So, Lizzie, first of all, the latest Brexit news would not only concern the EU, but certain MPs in his party. So is it just diverting attention away from Boris Johnson's issues?
Well, you could argue that this is Boris Johnson coming out guns blazing, trying to draw a line under that vote on Monday, which even some parts of the Tory press have called a hollow victory. But I would question where this is coming from. The Foreign Secretary, Liz Truss, wants to show that she's not afraid to stand up to Brussels. She is one of the runners and riders to replace Boris Johnson. And remember, once upon a time, she was a Remainer. And the reason I question it is the timing. This is such a gamble for Boris Johnson. As you mentioned, he'll stoke the anger of the pro-EU rebels in his party. Brussels isn't going to want to compromise when he's looking weakened. And if they retaliate with a trade war, it's only going to add to the cost of living woes in the UK.
Yeah, I mean, without making any judgment, I just find it incredible because they're the ones that signed the protocol in the first place. The other big news is, of course, the tech news and the Chancellor. Is this, again, him trying to appease the rebel factions that think this is no longer a Conservative government because they're increasing taxes by so much, or is it him trying to be Prime Minister?
Yeah, Sunak, another name on the runners and riders list to replace Boris Johnson, though he slipped down it because of that windfall tax on energy companies. So he's obviously trying to bolster his tax-cutting credentials, but this is a tax cut for business to boost productivity and hopefully wages. Will there be tax cuts, personal tax cuts, to help the poorest households through the cost of living crisis? That remains to be seen.
All right, Lizzie, thank you so much. Lizzie Burden there with the very latest on the UK. Coming up, Wizz Air sees booming demand from tourists keen for getaways during the summer high season. It's warning on staffing and air traffic control disruption, though, so we'll have plenty more on that story next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Wizz Air has reported a full-year loss as the pandemic continued to impact passenger numbers. The airline's chief executive told Bloomberg's Anna Edwards a little earlier that the airport disruptions have been felt across the industry.
we are seeing incredibly strong demand. The least issue in the industry at the moment is demand. People are back, people want to fly. Actually, people have some savings to spend. And the issue is a lot more around the supply chain performance right now. But in terms of demand, we are seeing a lot of people booking. I mean, if I just look at the last few weeks, our booking rate is 55% up versus the same period in 2019. So demand is incredibly strong.
So the last thing you have to worry about is demand. Demand is strong, but one of the issues that is creating is quote-unquote chaos at UK airports and maybe other places as well. You tell me, is this a UK story or is it elsewhere?
It is not a UK story. I think the UK story is probably a little bit bigger than in the rest of the world, but we are seeing systemic issues across the industry globally. The supply chain is out of labor resources. We are seeing constraints in ATC, air traffic management. We don't have enough controllers in the system. As a result, we are suffering a lot of delays and ending up with cancellations at the end of the day. We are seeing airport security, ground handling not having sufficient staff. As a result, they are putting a lot of strains on the operation of the industry. Yeah. So that's the issue.
So there's a number of issues you listed there. I mean, how many more flights have you had to cancel than would be normally operational?
I mean, we hardly cancel. I mean, we cancel less than 1% of our flights. But in recent days, we had to cancel 4% of our flights due to this very distressing operating environment. The industry must restuff itself. We need to get sufficient number of people properly trained to properly operate this industry. We have been maintaining some unproductivity in the system during the COVID period to make sure that when ramp up is coming, actually we are ready to ramp up. Many of the other players, stakeholders in the industry decided to lay people off in a big way, and now here we are, people are back to travel and they don't have people to support the operation.
Well, for more on Wizz and the summer travel chaos, we're joined by Bloomberg's European Airlines reporter, Siddharth Phillips. Sid, I mean, first of all, I know we need to talk about Wizz Air, but nobody really wants to travel at the moment because it's an absolute nightmare. It's a chaos. I've done it like 4 times in a week. For Wizz Air, I mean, any real surprises about how they're handling this?
No, I mean, I think the whole, the fact that fuel costs are rising is going to be some sort of concern as we go into the summer. But at the same time, we are looking at Wizz, and Wizz has been sort of one of the better off carriers compared with some of its peers like EasyJet and BA, which have had to cancel much more flights.
I mean, BA, we actually have some breaking news out of Brussels Airlines. This is according to the standards, cancelling some 148 summer flights. I mean, what is happening to BA? It seems like they're in the doldrums. Did they cut too many people off, and so can't? You know, there's so many flights that they can't operate.
So BA has been ramping up staffing. I mean, at the height of the pandemic, they did cut about 10,000 staff members. And so they are ramping up, but then at the same time, it is a hard labor market. It is very difficult to hire, and as well as the fact that you need security clearances and other clearances, which take time. So essentially, it's a sort of waiting game against the rush of summer demand.
Yeah. I mean, I'm going to confess that I've always been a huge fan of this airline, and now I'm thinking, like, I need to get somewhere. I'm looking at other airlines. Is there a worry that people will switch to airlines that are considered more reliable?
At the moment, it's sort of sporadic, so it keeps happening to different carriers when you least expect it. So, I mean, it's really hard to plan which carrier is going to have which cancellation at what date. So it's really it is a systemic problem across the board. The UK is facing it much more because obviously we've had the consequences of Brexit. But we've seen demand, we've seen issues at airports, including Brussels, in Dublin, in Schiphol, in Amsterdam. So across the board, we are seeing issues with security queues in airports, chaos at sort of check-in counters, and even those cancellations.
Sid, in 10 seconds, what did they miscalculate most? The demand or the cost cuts?
I think it's a question of, it's both. So they expected demand to come back sort of more gradual pace, and it's been a massive surge in pent-up demand.
Okay, Sid, as always, thank you so much. I could talk to you about traveling and the chaos of travel for the next 2 hours, but I know you have a full-time job to do. Sid Phillips there, our airlines expert here at Bloomberg. Now, in the meantime, Credit Suisse definitely left, right, and center for top news. A Bloomberg scoop suggests they're weighing a new round of job cuts after a warning of a second quarter loss. That's according to people familiar with the matter. The share price is down 5%. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz, and Anna Edwards. This is Bloomberg.
Many countries will have a hard time avoiding a recession.
I think that bringing inflation down should be our number one priority.
The last few years have been challenging in terms of just the volatility that we've seen.
But this is the sharpest slowdown in 80 years.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. More trouble at Credit Suisse. Shares are falling after the bank came out with a 6th profit warning in the last 7 quarters. A forecast from billionaire hedge fund manager Ray Dalio. He says central banks will be forced to cut interest rates in 2024 after their economies are hit by stagflation. And Angela Merkel's warning on Russia. The former German chancellor says Vladimir Putin made a big mistake by invading Russia, but isolating Russia in the long term isn't possible. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Lots to discuss then when it comes to geopolitics and when it comes to the global growth story, Kailey. For the moment, the European global equity risk asset picture seems a little indecisive at the start of this week.
Yeah, and of course, that's as investors continue to weigh both the growth and inflation picture, and we're continuing to see cuts to growth forecasts and elevation to inflation forecasts. We're just getting some breaking headlines out of the OECD, which cuts their global growth forecast to 3% for this year, 2022, then down to 2.8% in 2023. They see euro area inflation at 7% this year, 4.6% next year, while cutting the Eurozone growth outlook down to 2.6% for this year. The U.S. growth outlook for this year cut to 2.5%. And then as for the picture in Asia, the OECD cutting its China growth outlook to 4.4% this year. Of course, that is well below the 5.5% target that Beijing has set out. Now, speaking of China, we did get some better news on the regulatory front, maybe out overnight, with China approving licenses for about 60 video games. That is lifting sentiment that maybe the worst of the regulatory crackdown on Chinese technology companies in particular is over. So that really lifted risk sentiment in the region broadly. The MSCI Asia Pacific Index was up about 0.8% overnight, but the really outperformance came from those technology stocks. The Hang Seng Tech Index up nearly 5 full percentage points. The other big story out of Asia we're following is that the RBI, India's central bank, has joined the 50 basis point rate hike club. With that larger than expected hike to tame inflation, they signal that more is to come. Interestingly, you're not seeing too much reaction in the Indian rupee. It's actually fractionally weaker against the dollar at the moment, trading right around 77.77. But the big story in FX continues to be the Japanese yen. It is the biggest underperformer in both Asia and G10, weaker against the dollar by nearly a full percentage point. We're all the way out at 133.81 on dollar yen. That is the weakest Japanese yen once again in 2 decades.
It's
Matt.
unreal. I mean, imagine if you're Ford or General Motors trying to compete with Honda and Toyota. Sales in this country are putting fat margins on the books of the Asian automakers and not helping the U.S. Car makers at all. S&P futures right now down about 1/3% after a really incredible rally yesterday. I mean, we saw another turnaround in equity markets that was dramatic. So definitely a market that you want to be watching closely. The U.S. 10-year yield still holding steady at 3%. This was interesting after the first auction yesterday in which the Fed didn't play a massive role. I think it was a $44 billion auction of 3-year notes that went fine. NYMEX crude up about 0.2% to $120.22. So TI now over 120. Inflation, you know, you can stop it on household goods and bicycles, as I think we heard from the administration, but not on gas. And Bitcoin right now down about 3%, $30,000, 462. It's really not interesting the last few weeks to watch the price of Bitcoin, but everything going on under the hood is pretty amazing. Anna, Kailey and I had a great crypto show yesterday. If you didn't see it, you can get it on the internet.
You can get it on the internet. You can go to TV Go. You can watch older episodes of that program and of this one. Let's have a look at what's happening on these European markets right here and now, though, Matt. And we have some negativity across European stocks. We opened up in positive, trying to catch up with the U.S. session of yesterday. But that didn't last long in the face of slightly weaker U.S. futures. So CAC 40 and Xetra DAX both down 0.2%. The London market down 0.1% or so. Retail is a real area of positivity, though. And this is really interesting in the context of all the worrying we've done about Target, about Gap, Gap and all the retailers in the United States that have not done too well of late. This is the picture for European retail today. The sector up by 1.7%, and a lot of this is Inditex, and that is putting an upward sort of fire behind other retailers. Even in the UK, could there be some short covering going on of UK retail stocks, is what one broker is talking about today. So here's Inditex up by 4.5%. This is the fast fashion business that owns the Zara label. They seem to be managing their costs okay. They reported a decade-high level of profits, and there wasn't much talk about inventories and build-up of inventories. It seems that trading down for more expensive labels is something that could play to the advantage of a business like Inditex. So too for Wizz Air. This is a low-cost airline here in Europe, and they like to give you the same narrative that customers trade down when budgets are tight. The stock moving in the other direction, though, down by 6.7%. Disruption at airports overriding a strong demand picture. He said demand is through the roof, the CEO of Wizz Air, when I spoke to him earlier. Credit Suisse, we're going to get more details on this one, Kailey, shortly, but I just thought I'd emphasise the share price move we're seeing there. Another profit warning from Credit Suisse as the saga there goes on.
And that is something we will continue to follow throughout this program. We'll have more on that in just a minute. But first, let's take a look at what is ahead today. The Bloomberg Tech Summit will be kicking off with a great lineup of key CEOs, including the chief executives of Uber, Amazon, and MasterCard. Plus, President Biden and the First Lady will be in Los Angeles, California, to host the 9th Summit of the Americas. And finally, on the economic data front, we'll be getting Russia's CPI data out at 12 p.m. New York time, Anna.
Yeah, lots to watch out for then on the macro front. Let's get back to the corporate agenda. I mentioned Credit Suisse, the stock down by 5%. The company issuing its 6th profit warning in 7 quarters. The lender said it is accelerating cost savings across the group. Let's get more then with Bloomberg's Danny Berger. Danny, a focus then on cost cutting at the company. That's what they're saying now.
Exactly, cost cutting. And since then, Bloomberg has also learned that they're going to be concentrating on job cuts as well. According to people from Milano, this is ahead of a new update that they will give near the end of this month. But the update they've given us so far, yes, as you say, the 6th quarter in 7 of profit warnings. Not a great look, especially when less than 24 hours ago, the head of investment banking, of global investment banking, was saying, hey, we're back online, taking a victory lap with clients. Well, the investment bank, it's likely to post loss in the 2nd quarter, as is the entirety of the group. Now, they're blaming very macro forces. They're saying, look, we have a war in Ukraine, and at the same time, there's the inflation issue with monetary policy tightening extremely quickly. But of course, this is something that all banks have to deal with. So they're seeing client flow looking challenging. They're seeing deleveraging at the same time. So you have to wonder how much of this is the big banking picture, how much of it is Credit Suisse, which has lost 30% so far this year, just having a really hard time drawing a line under all of the scandals they've had.
All right, Danny, well, you mentioned the fact that banks broadly are grappling with tightening monetary policy, but Ray Dalio out overnight saying that a couple years from now, what we're going to be talking about is easing. Walk us through his thinking.
Yeah, so these were in comments to the Australian Financial Review, hence overnight, Australia time. So he said, essentially, we believe we are in tightening mode, and that can cause corrections or downward moves to many financial assets. That pain will force central banks to ease again close to the next presidential election in 2024, predicting a stagflationary environment. We heard it from the World Bank as well, warning about that with David Malpass. So yes, he says rate cuts might come. We are seeing markets in the U.S. starting to price in rates 2 years out, but that's not so unusual when you have this immense amount of rates hikes being priced in now. Sometimes that's just sort of a mathematical equation. But yes, Matt, the warnings are growing.
Oh, hey, Danny, how's it going? Yes, definitely watching that very closely. Bloomberg's Danny Berger, thanks very much. Now, after Matthew McConaughey made a plea for new gun control during a visit to the White House, that's 2 weeks after the elementary school massacre in his hometown of Uvalde, Texas. Let's get more now with Emily Wilkins, our Bloomberg government reporter, who joins us from Washington, D.C. And Emily, his message seemed really carefully crafted, not to offend the Second Amendment supporters in Texas.
Matthew McConaughey, he really presented himself as a Texan, as someone who grew up shooting guns and who grew up respecting the power that guns have. And that's kind of how we tried to message it when he was at the White House yesterday, gave a very emotional speech. You could kind of see him choking back tears, holding up photos of various students who were killed during the shooting at Robb Elementary School. And he has called for various policies to pass that would help eliminate some of these potential mass shootings, such as raising the age on the minimum age to purchase assault weapons. You saw him call for that in an op-ed, and you've seen him this week meet with lawmakers. He's been on Capitol Hill. He met with Speaker Nancy Pelosi's staff yesterday. He's met with a number of top lawmakers, and he was at the White House yesterday. I was actually speaking with a lawmaker who sat down with McConaughey on Monday in a bipartisan group of lawmakers, and he said that he is optimistic that this is a difficult issue, but he believes that there is a good chance to actually get something done. Of course, exactly what still remains to be a question. Republicans are very concerned about limiting certain types of guns or preventing individuals from getting guns, but there does seem to be potential movement around those red flag laws, which allow guns to be temporarily taken away from individuals who might pose a threat to themselves or others.
And obviously, Emily, this is an issue that will definitely be at the forefront of voters' minds as they head to the polls in November for the midterms. But before we get there, we saw a number of primary races yesterday, including the LA mayor's race. Billionaire Rick Caruso looks like he'll be heading to a runoff with Congressman Karen Bass. What stood out to you most out of yesterday's primary race results?
I think the big takeaway from yesterday's primaries, particularly with the mayor as well as with the attorney general recall, was that Americans do have high concerns right now about crime and crime in their communities. And they want individuals, candidates who are going to really be willing to crack down on that crime and make sure their communities are safe. I mean, this is a similar dynamic that we saw play out last year with the New York mayor's race and Eric Adams ultimately winning that. You've heard President Biden really take on that messaging, talking about their support for the police, wanting to make sure they're backing them, making sure they're lowering crime. But this is an issue that we expect to come up really in a lot of major cities and have a lot of Democrats wind up dealing with. And I think that's something we're just a repeating theme that we're going to see throughout the rest of these primaries and into the general election.
Emily, thanks very much. Emily Wilkins there, Bloomberg government reporter out of Washington, D.C. Now, Russia's foreign minister is in Ankara for talks that may restart grain shipments out of Ukrainian ports on the Black Sea. But Kiev is skeptical of the Kremlin's intentions. Let's get more with Bloomberg's European government team leader, Ben Sills. So, Ben, obviously they're skeptical after they've been under attack for the last, almost 4 months. Can you trust anything that the Kremlin says?
I mean, if you're sat in Kiev, it's very difficult, isn't it? I think the Ukrainians are conscious of the fact that their economy depends upon their ability to export critical commodities, including grain. They're conscious of the fact that the global food supplies, and particularly in countries like Africa, countries like Egypt and other African countries, the Ukrainian grain is really critical to maintaining food supplies, but at the same time, they're not about to send their ships out with Russian escorts. The Ukrainians have been saying they need third party, they need other nations to provide naval escorts, and agreeing that with Moscow looks extremely difficult.
Right, yes. I mean, the Russians saying they're ready to ensure safe passage for ships, but we take on board what you're saying about what Ukraine will make of those kind of commitments and assurances. We've seen also Angela Merkel warning against isolating Russia. So this is a slightly more long-term story, I suppose, Ben. What do we make of this intervention? She hasn't made all that many big interventions, I suppose, since leaving the Chancellery.
No, she's been very low profile. In part, this is about defending her legacy. She was a big proponent of building ties with Russia when she was in the Chancellery, and that obviously looks questionable now. She's very much in line with Emmanuel Macron, the French president, who was a big ally of hers when she was in power. Macron, with the same line that Merkel is making, has really angered the Ukrainians in recent days with his talk of not humiliating Vladimir Putin. You can kind of understand the long-term rationale, but at the same time, it's a stark contrast with somebody like, for example, Boris Johnson in the UK, who's very much kind of defending, and encouraging the Ukrainians to take a much more bullish approach.
All right, Bloomberg's Ben Sills, thank you so much. for joining us. Now, another story we're following is the plight of Cathie Wood's ARK Investment Management. The firm's lineup across 9 ETFs now holds just $15.3 billion, a 48% drop since the start of the year. That's the steepest drop in assets among the 25 largest U.S. ETF issuers. The drawdown in assets is a result of weak performance rather than investors yanking out cash. Now, the firm's flagship ARK Innovation ETF, ARKK, has plunged almost 55% this year, the second we're showing among its funds. It's currently higher by about half of a percent or so in pre-market trading. And don't forget, Bloomberg TV is actually going to have an interview with Cathie Wood herself later today, 1 p.m. Eastern time on ETF IQ, so don't miss that. As for some other stocks you shouldn't miss in pre-market trading this morning, one to point out is actually Western Digital. It said overnight that it's considering strategic alternatives after discussions with activist investor Elliott Management that could see the company split up its two businesses. That stock is up about 3% as a result. And I mentioned earlier the big rally we saw in Chinese tech shares in Asia overnight, and that is feeding right through to those ADRs as there's optimism around those video game license approvals, and if that means the regulatory crackdown is over. After Alibaba rose 11% in Asia, those ADRs up about 5.5% before the bell here in the U.S., Anna.
Lots to talk about this morning, Kailey, with Kallum Pickering, Berenberg Senior Economist. He'll join us shortly. We'll digest the new lines we've got from the OECD, their reduced estimates for growth this year. We'll get to that conversation. And it was the hottest hedge fund bet in years until it all started melting down. More from our big take story, that's still to come. Plus, how Walmart is dealing with labour and supply volatility. Part of our interview with the company's Senior Vice President of Transportation. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kailey Leinz here in New York, Anna Edwards in London. Now, we have seen record inflation in the Eurozone. 8.1% is the level right now, and the core number is climbing closer to 4. So the ECB, at least from the German perspective, seems to be way behind the curve. Noor Al-Ali joins us, Bloomberg's Market Live editor, to talk about what's going to happen at tomorrow's meeting in Frankfurt. Noor, what do we expect?
You're absolutely right, Matt. The ECB is definitely behind the curve when it comes to pricing and inflation. Inflation expectations have gone through the roof for the euro area. The debate now for the ECB is whether or not they continue to tout the 50 basis point hike in July, or if it's going to continue to be 25 basis points. I mean, all the hope is that we do see more of a hawkish turn from the ECB, and we do get those pointers for a 50 basis points move, or at least indicators that that's still on the table so the markets don't go wild.
Noor, good morning. I mean, we've had so many hawkish surprises recently, haven't we? We've had the RBA, we've had the RBI, and that's just in the last 2 days, both of them going more than have been anticipated. What would a hawkish surprise from the ECB tomorrow look like? Because we're not actually expecting a rate hike, as you said. It's about laying the groundwork for the future. And some people are already expecting 50 in July. So how could they be hawkish if they wanted to?
If they confirm that 50 is definitely on the table and it's a real consideration for the euro area. And let's not forget that the first quarter GDP final print today, usually the final is not, a big thing to consider, but it actually showed that GDP grew 0.6%, so that's 0.3% higher than the prelim figures. So you do have some numbers out here that shows you that perhaps the economy is doing well enough for the ECB to come out tomorrow and say, we're happy with 25 basis points. So 50 basis points, definitely the turn that we need to see.
Okay, Noor, thanks very much. Noor Al-Ali of the Bloomberg Markets Live team. And remember, you can get further market analysis. Check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. In the UK, Bloomberg's learned that Prime Minister Boris Johnson will go ahead with legislation to override part of the Brexit deal. That risks inflaming tensions with members of his own Conservative Party and the European Union. Johnson's government has been pushing to rewrite the Northern Ireland Protocol. That keeps the region in the EU single market while creating a customs border with the rest of the UK. Western Digital has announced a strategic review that could result in the separation of its two businesses. The announcement came after talks with activist investor Elliott Management and other shareholders. Western Digital is one of the world's largest makers of a type of chip, flash memory. It also makes disk hard drives. And the son of the founder of Walmart, Rob Walton, is leading a group that has agreed to buy the National Football League's Denver Broncos. That would be my team. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. And Matt, obviously, I'm into this story for a number of reasons. The record price, of course, is very, very interesting. The fact that this is a billionaire heir to the Walmart empire is interesting as well. And then also it's the Denver Broncos, which I am a lifelong fan of. We have Russell Wilson,
but why?
new ownership.
Aren't you from Virginia?
Feeling.
I mean, just because UVA has the same colors?
Well, I mean, that's just a happy coincidence, Matt. But my dad is from Colorado, born and raised. I had no choice in the matter. So here we are.
I'm sure it goes. Yeah, there you go. She's explained it. It goes much deeper. How dare you suggest such a poor reason for an allegiance to a team? I, on the other hand, know nothing about American football, so we'll say nothing. Let's tell you what's coming up on the rest of the program. Kallum Pickering, Berenberg Senior Economist, he joins us. We'll talk to him about expectations, reduced expectations for growth globally and in Europe. The ECB set to come out with its contribution to global tightening tomorrow. We will talk about that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. More trouble at Credit Suisse. Shares are falling after the bank came out with its sixth profit warning in the last 7 quarters. Bloomberg's learned it's now considering a fresh round of job cuts. A forecast from billionaire hedge fund founder Ray Dalio. He says central banks will be forced to cut interest rates in 2024 after their economies are hit by stagflation. Dalio told the Australian Financial Review the current tightening mode will cause corrections to many financial assets. And Angela Merkel's warning on Russia. The former German chancellor says Vladimir Putin made a big mistake by invading Russia, but isolating Russia in the longer term isn't possible. Merkel says there's a danger of Putin forming an alliance with China if he gets boxed in. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. We were searching for direction earlier on in the European trading session. Matt, we seem to have found it with weakness in US futures, but a bit of a lack of conviction. I guess we're all waiting for that inflation print at the end of the week.
Well, certainly we're watching for the inflation print and a number of data points, but keep in mind how trading's been this week. I mean, we continue to see these huge turnarounds. So even if you think that we've found a direction for the first 4 hours of trading, it could change by the end of the day. Yesterday we were down in the cash trade, and then we closed up pretty big. So right now S&P futures are off 0.4%. U.S. 10-year yield really little changed at 3.01. We just saw it, the yield coming down, and now we see the yield coming up. So a little bit of a flip-flop there as investors sell off that debt. NYMEX crude still over 120 for Texas Intermediate, 120.62 a barrel, and of course Brent is even higher. So this just adds to the inflation picture. Of course, not the core. The core of inflation is the stuff that you don't need. The stuff that you do need is getting more expensive. And Bitcoin right now down 3%, but still hovering around the seemingly unbreakable 30,000 range at 30,413. Kailey, what are you seeing in the pre-market?
Matt, when Bitcoin breaks out of that range, I'm going to get us hats. I feel like it'll be worth celebrating because it's been quite a while. As for what's going on in pre-market trading, this is a story we talked about earlier, but the optimism coming through for Chinese technology stocks after China regulators approved 60 video game licenses overnight. That is feeding into the idea that maybe the worst of the regulatory crackdown is indeed over, and that's giving a nice lift to ADRs of Chinese technology companies. Alibaba is up about 5.3%, JD.com by 4.3%. You also have DocuSign hired and announced an expanded partnership with Microsoft overnight, so that's lifting the stock the better part of 5 percentage points. And then a story we also mentioned earlier, Western Digital talking with Elliott, looking at strategic options, potentially the splitting of its two businesses. So that stock is up a little more than 4% before the bell as a result, Anna.
Kailey, European equity markets then a little bit sluggish this morning, down by 0.4%. A lot of sectors in negative territory. I pulled out one that's in positive, though, because it's an interesting comparison transatlantically. The retail sector here in Europe up by 1.6%. A little bit of short covering perhaps going on here as expectations for the retail space have been so damaged of late. But we do see some positivity around Inditex, and here's Inditex, lifting the whole sentiment around that sector. Inditex up by just over 4% today. This is the owner of the Zara chain, of course, and they came out with their numbers, a decade high profitability, managing their costs okay, and not much talk about inventories, which was, of course, the dominant theme when we talked about Target yesterday. And we've had a lot of gloomy reports coming through from, well, certainly some of the US retailers. Credit Suisse down by 5.25%. And, of course, this business has put out a number of profit warnings. This just the latest in a long line, Kailey. And they say, as we mentioned in our top stories a moment ago, they say that they're going to focus on costs, and we understand that means job cuts.
Yep, really interesting to watch that saga continuing to play out. It is just bad headline after bad headline for Credit Suisse. Let's bring in now Kallum Pickering, Berenberg Senior Economist, who is joining us now. Kallum, we've seen a number of cuts to growth forecasts, raises to inflation forecasts just in the last 24 hours. The OECD, the latest out just this morning, the World Bank yesterday cutting their growth outlook, warning of stagflation. And now Ray Dalio overnight in an interview with the Australian Financial Review said, and this is a quote, "We believe that we are in tightening mode, that can cause corrections or downward moves, ... The pain of that will become great and force the central banks to ease again, probably somewhere close to the next presidential elections in 2024. Kallum, what's your take on that?
Well, what we've just seen are two risks which simultaneously cannot occur together. We can't have a world in which we have runaway inflation, which is what the growth revisions are showing, and a world in which we can't afford these higher prices. If we can't afford these higher prices, then the inflation goes away. And so we're going to have to figure out which world we're in. At present, we seem to be in the first world. We have a big, an unbelievably large, in fact, nominal adjustment in the world where we're severely supply constrained. And so in real terms, output is stagnating or it's falling. But in nominal terms, everything is growing. So there's no lack of demand. The risk to watch here is that suddenly we get significant demand destruction in the second half of the year, and this turns into a disinflationary shock. But for now, there's no real evidence that that's happening, and hence central banks should be tightening monetary policy to try and arrest this nominal adjustment.
Kallum, why then are we starting to see job cuts pop up all over the place? On a micro level, it's really well illustrated by Tesla, although now Elon Musk has walked it back, and you never know what to believe that comes off of his Twitter account. But he was going to cut 10% of jobs at Tesla, and meanwhile, the waiting lists for their cars are 6, 7, 8, 9 months long.
Yep. Well, judging by the US JOLTS data, there are 2 job vacancies for every unemployed worker in the US, and that's an unbelievably tight labor market. It's a historically tight labor market. So let's have a 25% drop in labor demand. You still have 1.5 job openings for every unemployed worker. That will push wages up over time. You know, we just need to remember back to the 1970s. Things can get quite bad in a stagflationary environment. If you have this nominal adjustment, which becomes entrenched and aggressive, you can have rising unemployment and rising inflation. And so we just need to end this inflation as fast as possible. If that entails significant demand destruction in a temporarily weaker economy, unfortunately, that's what we're going to have to suffer. The narrow path to a soft landing is getting narrower each month. And so we have 2 problems, inflation and supply. Let's get rid of the inflation and with any luck, allow the private sector just to fix this supply problem over time.
So are central bankers really considering, Bullard, Dalio type scenario where they raise rates steeply at first and only to lower them at the end of next year?
Well, put it this way, central banks have already committed a policy error by overstimulating last year. Question is, can you now overcome that without another policy error, namely a recession? That's going to be difficult. History suggests it's difficult. And so you have 2 problems. If you over-tighten now, then you get a short recession, you get rid of the inflation, and you restart. If you under-tighten, the next recession is even bigger because you have to create deep downturn in demand. You have to generate a lot of unemployment to recalibrate inflation expectations. That's the Volcker scenario that you want to avoid. So if you're a central banker, especially the Fed, especially at the Bank of England, you say, let's play for a soft landing. But actually, we need to have a preference for running the risk that has the smallest output loss, which is the over-tightening.
Okay, that's interesting. Good morning to you, Kallum. I spoke to one guest this morning who was saying the UK is the canary in the coal mine for where the global economy goes because of the presence of these stagflationary threats. That was his view at Vander Research. But your view on the UK, the OECD saying this morning that they think that the UK needs to cut taxes before the economy grinds to a halt. That might sound inflationary. So do we have to decide which problem we're trying to fight here?
Exactly. I mean, to me, that sounds economically illiterate because you have very strong demand growth in the UK. Nominal wages plus bonuses in March in the private sector up 10% year over year. That's consistent with the inflation rate of 10%, and yet the economy is not growing because of supply problems. And so if you add to demand when your problem is supply, all you do is produce more inflation.
Okay, I think to be fair, reading a little lower, I think they said that they don't expect that demand situation to continue. They expect some of it to be destroyed in the future. That's their view. Onto the ECB, we see money markets now wagering on 200 basis points of ECB rate hikes by May 2023. Where is that? That's almost a year from now, Kallum. Does that chime with what you're expecting? I mean, how much tightening will we have time for before economies slow down?
Well, look, if economies are slowing down, if we are expecting demand destruction, then we don't want central banks to be doing much. Okay, the inflation problem will essentially cure itself because prices will have risen by too much. The ECB is in a different situation to the Bank of England and the Fed. The ECB faces mainly supply-side inflation, not excessive tightness in labour markets, and no risk that wages suddenly start shooting off to the upside, partly because there's a lot of collective bargaining in the Eurozone, so it acts like a speed bump between inflation expectations and wages. So the ECB can go slow. The Bank of England and the Fed, they potentially have a labour market and wage problem, so they need to address that. If I were at the ECB, they'll probably hike in the next couple of meetings, not this one this week, but they should be going a little bit slower.
Callum, I obviously cover a lot of the U.S. stocks here, as well as retailers, which have been in focus over the last several weeks. And Target, in just a 3-week span, has warned about its profit twice, cutting the margin outlook again yesterday, talking about these inflationary forces, the buildup of inventories that they now have to mark down merchandise to get rid of. What is the economic impact if we see others following suit?
Well, the risk is that we're already in a recession, unfortunately. Probably you got about a 40% chance of that outcome in the US. But we often think that the recession is the problem. No, the problem came earlier. The problem came because of necessary, but unfortunately highly distortive restrictions from COVID, the excessive Fed stimulus, the needless stimulus checks, similar policies in the UK and Europe, and now the economy just has to work all of this out. A recession is a normal part of a business cycle. We want to avoid them if we can, but we need to realize the problem is not the recession, it's what came before it that caused the recession. The recession may actually be the solution. If it gets rid of the inflation, if it gives supply chains just a little more time to adjust, then we should allow this to play out and then look beyond it. If we look beyond it, what we see is actually fundamentals are pretty good. If we can just give this process a little bit of time, I'd expect probably a year and a half from now, a pretty decent business cycle to emerge.
Right, and I'm guessing China maybe still plays an important role in where we go later in the year on that front. Kallum, thank you very much. Kallum Pickering joining us there from Berenberg. Coming up on the programme, it was the hottest hedge fund bet in years until it all started melting down. More from our big take story around hedge funds. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, OECD Chief Economist Laurent Spoon. That's at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, it was the hottest hedge fund bet in years. D1 Capital Partners used its stakes in private companies as collateral for borrowing billions and posted massive gains. But now, as valuations are fading, the industry is bracing for a reckoning. Our hedge fund reporter, Hema Parmar, joins us now to talk about not only the fact that they borrowed billions on these private stakes, but then they reinvested it in the same kind of assets. And so now as those fall, they're just losing a ton.
Yeah, and we're seeing this kind of across the industry. D1 is one of the bigger players when we look at hedge funds that are doing both public and private companies. And they've really sort of ramped up over the years. But now as we see, different ways that they can go about increasing their allocations to privates, taking on a loan to do so. But the industry is kind of going through this reckoning now as they look at how things are trading.
Well, how much exposure are we talking about when it comes to some of these more illiquid assets?
So, for example, D1, about half of their assets are in private investments. They're about a $20 billion hedge fund. Some of the other funds that have moved significantly into the space, Tiger Global,
By the way,
Viking.
half of their investments, and how leveraged up are they?
Well, we don't always have clear access into how much leverage they're using and everything, but clearly they've taken this, $2 billion loan. They've used some of that to reinvest in these sorts of private illiquid companies, and this is a big part of what D1 does, which is really pushing into startups, venture capital, more private equity type investments, and they're one of the bigger names in the industry that does this.
What do clients do when they're looking at the valuations of these assets being written down and yet they can't necessarily pull their money out easily? I mean, is this not a reputational problem for these funds?
Well, the investors do know from day one that when they invest in D1 and when they invest likely in other funds that do this, that these assets are likely going to be side-pocketed. So when you invest in it, you get in and then you get out when this private investment is exited in some way. They're often told that at the beginning, and we've been seeing a couple other funds like Tiger and Co. too saying, you know what, guys, if you want your money back, we're going to have to side pocket it as to be prudent for your money, but it means that they're not going to be able to get it back soon.
And so, Hema, how do these hedge funds consider the value or show the value of these investments in their books? And how frequently, I suppose, do they have to update those? I mean, you have this concept of mark to market, but when it's a private business, I wonder, what are the rules about how they have to hold the value of these assets?
So typically they will mark quarterly. Some funds that do more like venture capital stuff will, like a venture capital fund could mark annually. But each fund can mark things differently, and according to their own valuation policy. They can take different things into account, such as the fundraising round that was most recent, financials about the company, a basket of public companies that are very similar to the private company. And so these things can influence how they value the position, but it's not uncommon to see, different funds using their own methodology. They do have to do what they tell investors they're going to do and abide by their own policies, but different funds, depending on when they get in these companies, can have different marks for the same company.
So I suppose, Hema, that they will be, from what you said then, if they're using maybe publicly available movements in share prices, for example, as a kind of proxy for what they're holding, then they will be having to represent these losses fairly shortly.
Yes, we've seen some already in some of the funds, marking down things like Instacart, marking down a number of other private companies. Some of the funds like D1 will be marking quarterly, so at the end of this month, I think people are going to be keeping a very close eye to see what the marks are looking like, and I think the industry really is expecting a great deal of markdowns across the space as we look through the rest of this year.
Who are the winners that you're focused on? We hear so much about the losers, and it's a fantastic piece of reporting. I read it top to bottom as soon as I saw it. But who are the winners this year?
So, we're seeing some success among the macro funds. We're seeing success among the multi-strat funds. These are funds that are a great deal more diversified. They can trade currencies as well as stocks. They can some of them are market neutral, meaning they try to trade in a way that's not parallel to the market. And we're seeing a little bit more less volatility in those types of managers, while among the stock pickers or those that focus on public and private companies together, we're seeing a little bit more of a difficult time.
Hema, thanks very much. Bloomberg's Hema Palmer joining us there with more on the big take story. NI Big Take, that is the function to use on the Bloomberg to get a look at the big take story that we put out daily. Now, coming up on this program, how Walmart is dealing with labour and supply volatility. Part of our interview with the company's Senior Vice President of Transportation next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, Walmart's Senior VP of Transportation, Fernando Cortez, says the retailer has endured years of volatility. He spoke with Bloomberg's Ed Ludlow from the UP Summit in Bentonville, Arkansas, on Walmart's business challenges.
The last few years have been challenging in terms of just the volatility that we've seen around whether it's labor or whether it's capacity or just availability of goods. So we've had multiple challenges, but we have a very strong backbone, good partners, good vendors, and a impressive kind of group of associates that are always willing to kind of go and adapt and give the best that we can for our customers. So I would tell you that it's been challenging times, but we've been giving it a good fight, and we're excited about the future.
When you look around Crystal Bridges, the hangar over at Bentonville Municipal Airport, what were the technologies that kind of caught your eye? You know, is there anything that you saw and thought, I can integrate this into my fleet, I can use this?
Oh, there's so many, right? I mean, I'm an engineer by training, so I always kind of love electronics and kind of put them apart and separate them and kind of understand how they build. So yes, I mean, it was just like a kid in a candy store, so a lot of applications. I think you will continue to hear more on how we are thinking about them, but really exciting times here.
You also know supply chains. I think one thing that I was really interested in, I spoke to Stuart Walton about, is that short haul routes, you know, jumping just a few miles, traditionally done by truck or done by van. Now you have options like drone. You know, do you see the proportion of trucks in your fleet coming down and other technologies going up as the years go by?
Well, one of the things that we've had in the last couple of years with e-commerce growing and consumer preference changing on how they want to interact, whether it's a delivery or a pickup or just shopping at our stores, have given us the opportunity to kind of build this last mile solution from scratch. So that's, I think, where you will see more of these new technologies doing different things, whether it's electric, drones, zip line, kind of parachutes, all of these things that we're testing, and they're very, very exciting.
That was Walmart's Fernando Cortez with Bloomberg's Ed Ludlow. Now for what else we're watching today. And what I'm watching is kind of related to the idea of transport and logistics, because we have an interview with Emily Chang and Amazon CEO
We're right next
Andy
to each other.
Jassy. I am sitting next to Matt.
It always disturbs me.
As
I
you
know,
can see.
I understand why, but when we're in boxes and we're right next to each other, obviously I'm listening. Anyway, I'm sorry to the director.
And Anna is here in spirit, obviously. But Anna, I think I'm really looking forward to this conversation with Andy Jassy, just because of these kind of same issues, the idea of how expensive that transport and freight have gotten, and the labor issues as well. Plus, that's not the only conversation that will be happening at this tech summit. There will also be an interview around 12 p.m. Eastern time with Dara Khosrowshahi, who's the CEO of Uber. Then later on this evening, we'll be talking with the CEO of Expedia, Peter Kern. We got the CEOs of MasterCard in there as well. So it'll be really exciting to watch all of those interviews. And there's another interview on one of Matt's shows later that I'm also looking forward to.
Yeah, well, so you just saw Ed there at the UP conference in Bentonville, Arkansas. And I think this is a really cool idea. Stuart Walton yesterday was saying, look, there's over $1 trillion of capital there that could be funneled into startups and make Bentonville, Arkansas, you know, the hub for mobility startups. One of the people who's been the biggest bettor on mobility startups is Cathie Wood. We've been talking about her hedge funds today because they've been bleeding assets. I mean, down 48% year to date, the biggest ETF issuer asset loser this year, but still a huge figure. And so Ed's going to sit down and talk to her out of Bentonville this afternoon, and we're going to play that on the ETF show. So join us at 1 p.m. and hear from Cathie Wood.
That'll be great. And I'm very sorry I interrupted your dynamic. I was like, look, I'm doing it again. But I'm glad you rediscovered your physical connection. Matt, I'm talking about rates. And this is inspired by you, actually, because you asked yesterday, one of our guests, is 50 the new 25 when it comes to rate hikes? And I thought that was really interesting. And last night we heard from the RBI. They increased rates by a surprisingly high amount. And today we're going to hear from Poland. Interest rates set to go up by 75 basis points. This will be the 9th straight month we're seeing this from Poland. So a lot to talk about there. But this is a broader picture. Now, more than 50 monetary policy authorities around the world have increased rates by 50 basis points in one go so far this year, which I think is a really interesting statistic and tells us a lot about where we are in the rate hiking cycle. That is it for Early Edition. Surveillance is ahead. Lots more to come. This is Bloomberg.